Welcome to a new episode of Inside the Economist's Mind. Today we're really diving into something fundamental for economists: time series analysis.
Absolutely. It's a core tool.
You sent us some great material, specifically excerpts from the Australian Bureau of Statistics time series analysis, the basics. And our mission really is to get to grips with what these time series actually are. What are their key ingredients? And why do economists spend so much time on things like seasonal adjustment?
Yeah, cutting through that statistical fog sometime.
Exactly. We want to give you, the listener, a really clear view of what matters most here.
Perfect. We want that aha moment for you, understanding not just what it is, but why it's so important for tracking economic, ebbs and flows.
Okay, let's dive right in then. What actually makes something a time series? Let's start there.
Okay, so in essence, a time series is a collection of data points.
Right.
But crucially, they're well-defined data points, and they're measured repeatedly over time and at consistent intervals. That's key. Think of it like taking a regular pulse check.
Okay, so the ABS example, monthly retail sales, that fits perfectly, right?
Textbook.
The data, sales revenue, is clear, and the measurement happens every month, like clockwork.
Exactly. Now, contrast that with, say, data you collect just whenever or only once. That's not a time series. It lacks that regular, repeated measurement over time. You can't really see patterns emerge the same way.
Got it. Consistency is the name of the game.
Pretty much.
Now, the ABS document also talks about stock versus flow series. What's the essential difference there?
Good question. It's about what you're measuring at that point in time. Is it a snapshot or is it an accumulation over a period?
Okay.
So a stock series is like taking inventory, a measure at a specific point in time, a stock take.
Like the labor force survey example, measuring employment in one specific week.
Precisely. It tells you the state of things, the stock of employed people right then, like checking the water level in a bath at exactly 9 a.m.
Okay, clear. So what's a flow series then, using your bath analogy?
The flow theories would be how much water flowed into or out of the bath over, say, an hour.
Oh, okay.
It measures activity over a duration. So the ABS examples like retail trade total sales within a month or manufacturing output during a quarter. It's about the flow of activity.
How much right now versus how much happened between time A and time B. Makes sense.
You got it.
And the ABS mentions flow series can have trading day effects. Why is that something to watch out for?
Oh, definitely. Because those effects can introduce noise. They can mess with your interpretation.
How so?
Well, simply put, months don't all have the same number of trading days, right? February's shorter than March. And the mix of weekdays and weekends can change year to year for the same month.
Right.
So a jump in retail sales one month might just be because there were, say, 5 Saturdays instead of 4, not necessarily because people suddenly felt richer.
So it looks like a real change, but it's just the calendar playing tricks.
Exactly. It can obscure the real underlying economic signal. You have to be aware of it.
That's a really important point for interpretation.
Absolutely. And importantly, both stock and flow series can often benefit from seasonal adjustment to account for these calendar things and other regular patterns.
Okay, which leads us nicely into decomposition, breaking down the time series. The ABS says you can see an observed series as a mix of different components. What are those key pieces?
Yeah, generally we think of it as having 3 main ingredients. There's the trend, then the seasonal component, and finally the irregular component. Understanding all 3 helps, paint the full picture.
Let's take the trend first. What's that showing us?
The trend is the long-term direction, the sort of smoothed-out path the series is taking once you ignore the short-term bumps.
The underlying drift.
Yeah, exactly. It signals those fundamental shifts, long-run growth, maybe structural changes in an industry, that sort of thing. It's the main signal you're often looking for.
Okay, the signal amidst the noise. Got it. What about the seasonal bit? Why isolate that?
Well, the seasonal component covers those predictable movements tied to the calendar that happen pretty much every year.
Like the Christmas retail surge.
Classic example. Or higher water use in summer. Economists need to account for these because they can be quite large and can easily hide what the underlying trend is actually doing month to month.
So the expected ups and downs.
Right. And the ABS rightly points out it's not just those annual cycles. It includes those trading day effects we just talked about. And also moving holidays. Think Easter or Chinese New Year.
Right. Easter jumping between March and April can really throw off comparisons if you don't adjust for it.
Totally. A big reason we need seasonal adjustment.
Okay. And the last piece. the irregular component?
That's basically everything else. It captures the unsystematic, short-term fluctuations, the unpredictable stuff.
Like one-off events,
Yeah.
random shocks.
Exactly. Think maybe an unexpected policy announcement, a natural disaster affecting supply chains, maybe just sudden market jitters. These irregular bits cause deviations from the trend and the seasonal pattern.
Okay, so we've got the long-term direction trend, the predictable calendar wiggles, seasonal, and the random noise.
Irregular.
That's the framework, yeah.
So now let's really focus on seasonal adjustment. The ABS defines it as estimating and removing those systematic calendar-related effects. Why is this so critical?
It's absolutely vital because those seasonal patterns, while predictable, can often be quite large and can completely mask the underlying story.
Mask it how?
Well, they can hide the true momentum or maybe emerging non-seasonal trends in the data. You need to strip away the predictable stuff, the Christmas rush, the summer slowdown, to see what's really changing in the economy's fundamentals.
So policymakers can see the real impact of their actions, maybe, without the seasonal noise. Precisely. Imagine trying to gauge if a tax cut is boosting spending. If you don't adjust for the usual pre-Christmas surge, you might think the policy is way more effective than it really is.
Right, you'd misinterpret the seasonal effect for a policy effect.
Exactly.
Okay, and the ABS asks this great question. Why can't we just compare original data from the same period each year? I mean, it sounds simple enough. March this year versus March last year? What's wrong with that?
It sounds simple, but it has some major flaws from an analyst's perspective.
Like what?
Well, first, those moving holidays we mentioned. Easter can be in March one year, April the next. Comparing March to March doesn't work if Easter's impact has shifted.
Right, you're not comparing like with like,
Yeah.
apples and oranges.
Pretty much. Second, seasonal patterns themselves aren't always static. They can change over time. Consumer habits evolve, industries change. A simple year-ago comparison assumes the seasonal pattern is exactly the same, which might not be true anymore.
Okay, so the pattern itself might drift.
It can. Third, those training day effects again. Even comparing March to March, you might have a different number of working days or weekends, which can skew the raw numbers.
Even year on year. Got it.
Yep. And maybe the biggest issue. The original data still has that irregular component mixed in.
The random noise.
Right. If there are significant short-term unpredictable bumps, just comparing year on year might still not show you the true underlying trend clearly. It can be masked by that noise.
So basically, all these factors act like static if you're just doing that simple year-over-year thing.
That's a good way to put it. And the ABS points out something really critical for economic forecasting. You're often much slower to spot turning points.
Turning points, like when the economy shifts from growing to shrinking or vice versa.
Exactly. Those are crucial signals.
Can you give an example of missing one?
Sure. Imagine, let's say, housing approvals were growing strongly year on year for a while, but then within the current year, they peaked in August and started a slow decline. Now, if you only look at the October figure compared to last October, it might still be higher than a year ago, just because the level was so high earlier in the year.
So the year-on-year number looks okay.
Right, it looks like growth is still happening.
Yeah.
But you'd completely miss the fact that the momentum shifted 2 months ago and things are now heading down.
Wow, okay.
Seasonal adjustment helps reveal that downturn, that inflection point, much, much sooner. It gives you a clearer, more timely picture of the change in the underlying trend.
That really drives home why seasonal adjustment is so powerful. It's not just tidying up the data.
Not at all. It's about seeing the real story sooner.
Okay. But are there times when seasonal adjustment isn't the right move? When might it be inappropriate?
Yeah, there are cases. If a time series is just overwhelmingly dominated by a really strong trend up or down, or if it's incredibly volatile, just bouncing around randomly, a huge irregular component, and there's hardly any detectable consistent seasonal pattern.
So if seasonality is tiny compared to the other parts,
Exactly. Trying to estimate and remove a tiny or non-existent seasonal effect can actually introduce errors or create misleading patterns in the adjusted data. It might make things look smoother than they are or introduce bumps that aren't real.
so don't force it if it's not really there.
Pretty much. Use it when there's a genuine, identifiable seasonal pattern to remove.
Okay. So how do you spot that genuine seasonality in the first place? What are the visual clues?
You look for those regular ups and downs, peaks and troughs that appear at roughly the same time each year.
Consistent timing.
Yeah, and they should have a reasonably consistent direction and size each year, relative to the overall trend level.
So not just random spikes, but a recurring pattern.
Exactly. The ABS is figure 1, those NSW retail sales. That December spike every single year is impossible to miss. That's strong seasonality.
And you can see how the size of that December spike seems to grow as the overall sales trend upwards.
Good point. And that observation actually gives us a hint about which type of decomposition model might be best, which we can get to later.
Okay, visual patterns are key. Now, back to the irregular component for a second. If that part is really large, what does that tell an analyst?
It signals a lot of short-term unpredictability, high volatility.
Like figure 2.
Yeah.
The building approvals in ACT.
Perfect example. That chart is all over the place. When the irregular component is that dominant, it makes it really hard to clearly see the underlying trend, or even a consistent seasonal pattern. The random noise is just drowning out the other signals.
Yeah, looking at that, it would be tough to say with confidence where things are generally heading.
Very challenging, requires careful techniques.
And then the trend itself. The ABS defines it as the long-term movement, stripped of the seasonal and irregular bits. What kind of factors drive that underlying trend?
Well, for economists, the trend reflects those big fundamental forces, things like population growth, overall economic growth, inflation, technological change, long-term investment, maybe shifts in government policy over time.
The slow-moving major currents.
Exactly. Like in figure 3, the quarterly GDP chart. That steady upward slope reflects the long-term expansion of the economy due to those kinds of factors.
Okay, so we have these three conceptual pieces. How do analysts actually separate them mathematically? The ABS mentions different models, additive, multiplicative, pseudo-additive. Why the different approaches?
Because the way these three components interact isn't always the same. Sometimes they just, well, add up.
Literally add.
Yeah, that's the additive model. The idea is observed value O equals trend T plus seasonal S plus irregular I, O equal T plus S plus I.
Okay.
This model works well when the size, the amplitude of the seasonal swings and the irregular bumps stays pretty much the same in absolute terms, even as the trend goes up or down.
So the Christmas sales jump is always roughly the same dollar amount extra, regardless of whether overall sales are high or low.
Kind of, yeah. Or like the government transfers in figure 4, those seasonal spikes look fairly consistent in size over time. In this case, the seasonally adjusted series is just the original minus the estimated seasonal part. Simple subtraction.
Okay, straightforward. But what if the seasonal swing isn't consistent like that?
Right. And very often in economics, it isn't. Often, the size of the seasonal effect, and maybe the irregular volatility too, tends to grow or shrink along with the overall level of the trend.
Like the retail sales example, where the December spike got bigger as overall sales grew.
Exactly. In that case, a multiplicative model usually fits better.
Multiplicative, meaning multiply.
Yes. The assumption here is observed equals trend times seasonal times irregular. O equals TSI.
Okay, how does that work?
Here, the trend component keeps the original units, like dollars. But the seasonal and irregular components become unitless factors, usually fluctuating around 1.
Factors around 1.
Yeah, so a seasonal factor of, say, 1.2 for December means sales are typically 20% above the trend that month. A factor of 0.9 for February might mean 10% below trend.
Ah, so it's proportional.
Exactly. The seasonal effect is seen as a percentage of the trend. To get the seasonally adjusted series here, you divide the original data by the estimated seasonal factor.
Oh.
And the ABS notes this multiplicative model is actually the one they use most often for economic data. Figure 5, the job ads, where the swings get bigger as the level rises, fits this idea.
That makes intuitive sense for a lot of economic activity. Growth often means bigger swings.
It often does.
Now, there was a third one, pseudo-additive. That sounds complicated. When does that come into play?
It handles a specific, tricky situation. The multiplicative model runs into trouble if the time series has values that are very close to 0 or actually hit 0.
Because you can't divide by 0.
Right. Or dividing by a tiny seasonal factor can blow things up. Think about something like, say, quarterly crop production, like figure 6. There might be a quarter where literally nothing is harvested, the value is 0.
Okay, yeah.
The pseudo-additive model is kind of a hybrid. It allows for the seasonal variations to still depend on the trend level, like multiplicative, but it handles those 0 or near 0 values gracefully, avoiding impossible results like negative adjusted values. It assumes S and I depend on T, but are independent of each other.
So it's a specialized tool for those specific cases with zero values.
Essentially, yes. It's needed when multiplicative breaks down mathematically, but the relationship still seems proportional.
So faced with these options, how does an analyst actually choose the right model for their data?
It usually starts with just looking at the data,
Right.
graph the original
That
series.
visual inspection again.
Yep. Do the seasonal peaks and troughs look roughly the same height regardless of the trend level? Maybe try additive.
Okay.
Do they seem to get bigger or smaller as the trend goes up or down? Multiplicative is probably a better bet.
Makes sense.
Are there zero or near zero values, but the seasonality still looks related to the trend level? Then you lean towards pseudo-additive. Often, analysts might actually try fitting different models and see which one gives the most stable, reasonable-looking seasonal component.
So a bit of visual art and statistical science combined.
You could say that.
The ABS also mentions seasonal and irregular SI charts.
Mm-hmm.
What are they showing us?
Right, SI charts. Once you've estimated the trend and removed it, what's left is the combination of the seasonal S and irregular I components.
Okay.
An SI chart plots these combined SI values, usually grouped by month or quarter over time. Often the estimated seasonal component, which is basically a smoothed version of the SIs, is plotted on top.
And what's the point of looking at that?
It really helps you see the difference between the regular seasonal pattern and the random noise. Is the variation you see in a particular month mostly the predictable seasonal part, or is it dominated by irregular fluctuation?
Like in Figure 8 for the ACT building approvals.
Exactly. That SI chart shows loads of volatility. The SI points are scattered all over, telling you that the irregular component is really dominant in that series. The seasonal pattern is much harder to pin down.
So it helps distinguish systematic from random variation.
Yes. And they can also be useful for spotting breaks or changes in the seasonal pattern over time, or seeing the impact of those moving holidays more clearly, or identifying extreme outliers.
A way to zoom in on the short-term stuff after dealing with the trend.
Precisely.
And finally, just briefly, the document mentions Shishkin decomposition. What does that add?
Shishkin is, let's say, a more comprehensive, often automated procedure. It provides a very detailed breakdown.
More detail.
Yeah, you typically get outputs showing the final seasonally adjusted series, the trend estimate, the SI factors, sometimes separate factors for trading days, the works. Figure 7 for retail turnover shows that kind of detailed output. It gives economists a really thorough dissection of all the different forces at play.
Sounds like the full diagnostic toolkit.
It kind of is. Provides a lot of information for deep analysis.
Okay, fantastic.
Yeah.
So let's try and wrap this deep dive up. We've journeyed through understanding that time series data tracks things over time at regular intervals.
Mm-hmm.
We've seen how economists break it down into that long-term trend, the predictable seasonal patterns, and the random irregular noise. And we've really dug into why seasonal adjustment is so crucial. It strips away those calendar effects to reveal the underlying economic story, helping us spot turning points much earlier than just comparing raw data year on year.
Absolutely. And we touched on the different ways to model that decomposition, additive, multiplicative, pseudo-additive, depending on how the components interact.
Exactly. Understanding these basics really gives you, the listener, a much more powerful lens for looking at economic charts and reports you encounter. You can start to see beyond the headline number.
You can start asking, okay, is that movement just seasonal or is something more fundamental changing? It's a really valuable skill.
Definitely. So here's a final thought to leave you with. We focused on economics, but cyclical patterns are everywhere, right? In nature, in business, maybe even in our own routines. So thinking about the data you encounter day to day, maybe website traffic, maybe project deadlines, maybe even your own energy levels. What other kinds of information might benefit from this kind of time series thinking? Where else could looking for trends, seasons, and irregularities help you understand the underlying story better? Something to ponder beyond just the economic sphere.